please speak as you might to a young child or a golden retriever.
It's an unfair game.
They're schemers. Schemers trying to control their little worlds.
The rich get richer, that's the law of the land.
It's just money.
Blasphemy! This is madness!
I drink your milkshake.
Hey everybody, welcome back to Milkshakes Markets Madness. My name is John Kutsmeda. This is Brent Johnson, the man behind the dollar milkshake theory. If you're new to the show, we encourage you to visit our YouTube channel using the handle @MilkshakesPod. At the top, you'll see a playlist that says Start Here. So if you have no idea who Brent is or what the dollar milkshake theory is, or need a little bit of a perspective on how we think the monetary system operates, you'll enjoy those select videos to take you down that rabbit hole. Now, this is going to be our full-length episode. You'll also notice on our channel, everything is broken into segments. We post this one on the weekend. It tends to run a little longer as we like to recap the week and maybe share some thoughts on really everything that's been going on in the world and in markets. Now, Brent, to start this one off, I'm kind of thinking, it's been a crazy year. It's hard to believe we're days away from entering November. We're really at the denouement of the year. And, I think of Back to the Future, the second one. I think that's the one when Biff finds the sports book. Yeah, with all the stuff.
All you got to do is bet on the winner and you'll never lose.
All right, I'll take a look at it.
So look, here we are. We're coming to the end of the year. There's some things that played out, maybe not exactly on the timeline or in the manner in which you thought they would, but looking at where things are at this exact moment, if you had that Biff Playbook and you knew that there was going to be either a melt up or a meltdown or a recession or a crash, let's just say it's going to be some sort of significant pullback because generally speaking, that tends to be what happens when you're in these extreme tightening cycles. So if you were looking at what's going on right now, and we'll look back on some of the things we've talked about throughout the year and even at the beginning of this quarter, but what would you say would be the thing that triggers a significant event in the market, potentially a negative event in the market when you're just looking at the current price action or volatility?
Well, I think there's a couple things. One, I'd say part of the event has already happened, and I'd say over the last 4 to 5 weeks, we've started to experience that negative event, and it's starting to pick up speed. And I think we have a couple potential catalysts for further action right in front of us, namely what continues to go on in the Middle East. That ramped up fairly significantly on Friday evening, so it'll be interesting to see how markets open this week. And then we've got the Fed meeting this week, right? That always has the potential to be a catalyst. If I had to guess how things are going to go between now and over the next 2 months, and again, these are just predictions. Nobody actually knows. Anybody that tells you they do know, run the other way. But I think we're probably going to have more downside this week. Markets are actually getting to the level where they're fairly oversold. My guess is that the Fed will do another hawkish pause. I've been in the camp all year that they're not going to cut and they're actually going to hike and they're going to be more hawkish than people are expecting. So I'm still in that camp, although I'm not sure that they're going to hike again this meeting. I think they'll probably do the same thing as last meeting. Perhaps if we have some downside prior to that meeting, that hawkish pause will allow the markets to breathe a little bit because if there's not a raise, maybe we'll go sideways for a couple of weeks or even bounce for a couple of weeks. But then 2 or 3 weeks from now, when the Fed minutes come out and, there's a little bit more data has come out and, they're going to say we're data dependent and as more data comes out, if it's not really bad, I think the market's going to have to continue to come to terms with the fact that we've got trouble in the Middle East. The dollar has remained strong. The Treasury is going to continue to issue bonds. That's probably going to push yields higher. That's probably going to pull more capital into the dollar. And that's probably something that the market's going to have to come to terms with. And so I think that's potential further downside. And not only that, but we've kind of been in the heart of earnings now, right? And, we talked about this a couple of weeks ago with Tesla. And then over this last week, we had a lot more earnings came out. The tech earnings were not fantastic. In some cases, they were bad. And, the charts are showing that now we've if we look at the number of these weekly charts, they've actually broken support now. And so, if we have further deterioration or further negative guidance, from some of these earnings, we've talked many times about these passive markets. Once they get trending in one direction, they tend to continue going in that direction. It's really hard to turn them, but once they turn, then it's hard to get them to turn back up again, right? And they've kind of turned. And so, it doesn't necessarily mean that it'll be an elevator shaft down, but I think it's going to take a fairly significant positive catalyst to turn them back higher and continue going higher.
Thanks for that, Biff. Well, look, you are late in your evening. I'm fresh in my day, so I might throw a few more nonsense analogies, particularly around the movie vibe. The idea that the Fed has found itself and has been finding itself in between a rock and a hard place for 20 years makes me think of Ocean's 11 and the guy who hides in the box. It feels like they're almost comfortable in this situation, right? And so there's this expectation that they're going to flinch or blink and do some sort of drastic move. And as you've said throughout the year, you just don't think I think you have shared that you think people are underestimating the Fed and that they're not so ready or prepared to be as quick about pivoting and going the other direction as far as providing accommodation to the markets. Now, we've also had, you're talking about this hawkish pause potential, although you still feel like they might have one more rate hike in their gun. Well, GDP beat expectations, 4.9 versus 4.3. You've had the core PCE was right on target. It's not horrible, but it's not great. It's 3.7 year over year. We've talked a lot about how some of that, when you're comparing it to previous numbers, can paint a misleading picture, but it's still trending up and it's above the 2% inflation target. One of the other things that happened at the end of the week that's worth noting is the consumer confidence. I think it was the Michigan consumer confidence data showed a big uptick in consumer expectations around inflation. So you've had this situation in the Middle East that's certainly spooked markets. Yields get to a certain point where it sucks in the dollar, but it also sucks in domestic capital because the risk premium for taking any kind of risk versus the risk-free rate suddenly doesn't become as attractive. So maybe there's some rebalancing there. But do you feel like some of the data I just shared with you continues to suggest that, this hawkish pause may not be enough? The Fed is far from over in terms of fighting this fire?
Well, in the sense that I don't think that they're going to come out and start forecasting a bunch of Fed cuts for next year, I would absolutely agree with you. Now, I don't think the Fed has to continue raising in order to tighten monetary conditions. And we've talked about this a little bit with the lag effect, right? A lot of what they did was front-end loaded last year. They continued to raise this year, but not at the same pace. And Powell even addressed this directly a couple of weeks ago when he spoke. He talked about the lag effect and how he expected the lag effect to start to show up now. And now we have, since the last meeting, when he basically took away the previously predicted Fed cuts for 2024 that were showing up in the dot plot, the long end of the curve, is finally grudgingly rising to meet those higher for longer Fed projections. And I think that's where I think the Fed has been more resolute and the market has not been willing to accept that this year. And I think that's largely why the market was higher this year. I think the market was higher on the expectations that not only were they not going to continue to raise, but that the Fed cuts or the rate cuts were right around the corner. And I think as that continues, based on the data that you just mentioned, I think that's the path that they stay on. I think it's very hard for them to just come out of the blue and turn uber dovish and start predicting rate cuts when the data is still pretty strong. And they have said over and over and over again, we're willing to accept some economic pain in order to get inflation lower. And so I think the other thing is it still happens all the time when I interact with people, mostly on social media, Twitter, or even at conferences. And when I talk to people, I say, well, the Fed, they're going to have to print. They're going to have to print. And I'm like, well, why? Why do they have to print? The market's still within 5 or 10% of its all-time high. Why do they have to print? Of course they will. When and if they have to print, they will. But why do they have to do it right now? And the point is they don't have to do it right now. Now, if we wake up tomorrow morning and as the result of some new economic data or because of something going on in the Middle East or some new geopolitical conflict that, nobody's ready for, and the stock market is down 25%, and yields are blowing out, then yes, the Fed will come in and they will print, or they will buy bonds and they'll go back to QE. But as of if everything kind of continues to trend as it is right now, and the data doesn't get materially worse, and in fact, it's been pretty good if you just look at the data, there's nothing that says they have to imminently cut. And so I think everybody knows they eventually will have to. But whether that's next week, next year, or 2 years from now, nobody knows. And I think all the people who are saying they're going to have to cut have been saying they've been going to have to cut for at least a year. I don't know anybody who had said they're going to hike into the fall of 2023, and then they're going to slow down, and then maybe a year later they'll cut, right? I don't know anybody who said that. I know a lot of people who've been saying they're going to have to cut for the last year. But so far they haven't had to. And so I think the market is still largely coming to terms with that. And I think that's why we've seen yields continue to rise, the dollar remains strong, and for the most part, equity markets continue the violently sideways action, since we're kind of back to where we were in May now, right? And really, if you look at the whole year, I think the S&P's up 6 or 7, the Dow's up. Maybe the Dow's even flat to down now. The NASDAQ's still up pretty significantly, but now we could easily be back to flat to down for the overall markets by the end of the year. And I don't think the Fed is really upset with that. Again, the Fed, when they started on this hiking journey, I think, in my opinion, they had in their mind that they would have to start a recession in order to get inflation under control. So if 2 years into it, the market is largely where it was when they started, or 5 to 10, 15% below where it started, I don't think they're upset with that. I think they're fine with that. They, again, getting asset prices down is part of getting inflation under control. So I think it's really important to understand what the Fed is trying to do in the first place, as opposed to just sticking with the narrative that they're going to print. Because the whole point of what they've been doing the last year and a half is the exact opposite of they're going to print.
Well, there's another Biff's Playbook example, right? We've got people making these predictions based on, what they think is the playbook. I think you were generous by saying over the last year, but let's be honest, the first Fed rate hike was March 2022. It was 0.25%. Yeah. And people have been saying, oh, the cuts are just around the corner since then. So I think saying a year is generous. I mean, people have been screaming from a mountaintop that this is going to lead to the end of the world. And there was a funny tweet we were sharing and laughing about on Twitter recently, which showed this huge dip in a chart. And right before the dip, the quote was "get long," and then the massive sell out for a really, really long time. And then eventually it came back up and had surpassed the previous price when the person had said "get long." And the other quote was, "See, I told you." And so there's, right. I think timing and the length of time for these things to play out is so frequently overlooked that, you're really not right if you're early. And that's, popular saying, early is the same as being wrong. But, when it comes to just being a macro economist, not really responsible for, managing money and generating returns, it's real easy to look back 3 years later and say, see, I told you so. But with that in mind,
what I think is also, before we leave that, the other thing that I think is really interesting, and this kind of goes back to your, having Biff's playbook, unless you keep an open mind, having all of the data, Let's say you had all the data except for what the stock market did. Let's say you knew what GDP was going to be. You knew what inflation prints were going to be. You knew what this policy was going to be and what happened, what those earnings were going to be. If you had been bearish and unless you kept an open mind when you started getting that info, you would probably still be saying, the Fed's going to cut, the Fed's going to cut, the Fed's going to cut, right? But only if you open your mind and you see these prints, the inflation prints are coming down, you see that earnings are holding up, you see that GDP is beating and expecting, would you have had the guts to go long? Even if you had the book ahead of time that told you that would happen? My guess is that for a lot of people, the book wouldn't even help them, and it might actually hurt them because they wouldn't be willing to accept the data that was presented to them because it didn't fit their narrative. And so I think that's very kind of, I'm glad you brought up that movie and that example, because I think it's a very good way, to think about things. Again, you have to put yourself in the Fed's shoes, and you have to think like the Fed. It doesn't help you to put yourself in the Fed's shoes if you continue to think like you do. You not only have to put yourself in that person's shoes, but you have to put yourself in their mindset as well. And again, the Fed is trying to slow the economy. So if the Fed is trying to slow the economy, why on earth would they be upset if stock prices fell, right? Now, if they crash and we have a meltdown, that's a different story. But falling is no problem for them.
Yeah, and this has been a big theme all year long in regard to kind of the Fed having its cake and eat it too, in that they've been able to raise aggressively. They most likely expected a recession, got their mind around the fact that that was going to be a consequence they would be comfortable with, but they've come this far, raised 550 basis points, haven't had that recession, and markets haven't really budged really either way. They're kind of sideways. But what's interesting about that is you talk about the playbook. We also talk about looking back on all the different things that have gone on this year. Just recent, I believe last week's episode, we entitled it "Burn It All Down," and we used this fun quote from Winnie the Pooh. But the part of the conversation in that episode was the yield curve. And we talked about if you looked at it for what it was and tried to understand maybe potentially what the Fed would interpret that as, instead of trying to force your narrative into what it meant. And that, again, if you're hunting recession and everything, I forget what it's called, but if it's like you're in the market for a red Corvette, suddenly you start seeing red Corvettes everywhere. And so if you're desperate for a recession, everything looks like recession to you. And so what's interesting about that, partly in terms of the calls that you've been making this year, I think you've been very patient in terms of seeing some of those play out and positioning yourself accordingly. But earlier in the summer, you felt like things had run further than they should have. You admitted they went higher and longer than you expected them to, particularly in the tech sector. And what's, the NASDAQ outperformed so much that, the returns there were definitely painful for anyone who didn't participate that. And there was that urge to chase it. Now it's hard to believe, but Brent, I don't even think it's been 2 months since NVIDIA, ripped higher after this incredible earnings beat. But tech overall since then hasn't really been pulling its weight. We've talked about the Magnificent Seven, which is primarily tech stocks, that's been carrying the entire index, or the S&P and various indexes. But now when we're looking at where we are, we're kind of seeing some of Biff's playbook play out in front of us, and we're trying to figure out what the next move is. You have, on one hand, from a collateral standpoint, bonds getting crushed, which makes credit growth and bank lending and everything else much more difficult to do. But you also have gold now crossing the Rubicon of 2000 while tech is pulling back. This is kind of a three-way tug-of-war. Who do you think wins here? And is there a message being played out by the markets, the fact that tech has pulled back and gold has ripped higher?
Well, so we got to kind of split this apart, because I think a week ago or 2 weeks ago, this would have been a much easier question to answer, because it's really only in the last, 2 or 3 weeks now, since the flare-up in the Middle East. But, if we go back to the last Fed meeting, that is when yields started to rise on the long end a little bit quicker than they had been. They yields had already been rising, but that's when they kind of begrudgingly kind of went higher, and even the 10-year has come up and touched 5%. And again, that's what we've talked about, the long end coming to terms with the higher for longer. And that has implications for stocks for the reasons you explained. It has implications for tech, especially because technology, and I don't know if a lot of people realize this, and I didn't know it for a long time, and a friend of mine explained it to me probably 6 or 7 years ago. And that's when it really made a lot of sense once I really thought about it. And that is that technology has a built-in fixed income component more than other equities. And what I mean by that is technology stocks tend to be growth stocks. They tend to not to have big dividends, right? Because they're spending all their money in order to grow and research and development and build new product, all of this stuff. And so when you discount future cash flows and interest rates are lower, you get a higher valuation. And typically and that plays into tech stocks. And also when you have really low yields are typically indicative of a very low growth environment, right? And if there's not very much growth out there, then the market will pay a higher valuation for the little growth that does exist. So think of it just as pure supply demand. If you're trying to buy growth and there's just not much growth out there, there's very little supply. But there's huge demand for growth because everybody wants to increase the size of their portfolio. So when you have a lot of demand and a small supply, that tends to push the price up. So that's another reason that technology has kind of a built-in interest rate component to it. So when you so the reason that's important is because, since the last Fed meeting, as rates have risen since then, that puts downward pressure on tech valuations because of that built-in interest rate play. Raising rates also affects gold, and we've talked about this, right? Gold had held up all year extremely well in the face of rising real yields. But post the last Fed meeting, when interest rates especially in the long end, started rising more and real yields started to rise more, gold finally fell, and it fell like $100 or $120 within a couple of weeks. And I think that would have kept happening, or at least it would have stayed at that lower valuation had the situation in the Middle East not happened. Now, I'm going to say something that I know people are not going to like, and I know they're going to disagree with me. And I'm sorry, because I'm really, really sympathetic to the other side of what I'm going to say. And that is, in my opinion, and listen, I can absolutely be proven wrong. And this is why I'm glad I already own gold, because I don't have to chase it at these prices. I think what's going on in the Middle East is the worst thing that could happen to gold, because it was falling and a lot of the weak hands were getting washed out. And I think we were so close to a complete washout, which would then have built a fantastic base for gold to run to all-time highs and stay up there. But because I think but gold has risen $200 in the last 2 weeks, largely on what's going on in the Middle East. And I don't think that is good for the longer term. It's good in the short term, but I think if and when things kind of not necessarily calm down in the Middle East, because I don't think they're probably going to calm down, but when they become more clear and the uncertainty of it is removed, I think gold is going to fall back. And I think a lot of the people who chased it higher on Armageddon concerns or World War III concerns or whatever it is will be quick sellers when it goes against them. Remember, a lot of times when gold gets bought, it gets bought on leverage, because a lot of the gold price is influenced by futures. Futures have inherent leverage in them. When it goes against you, you either have to post more collateral or you have to sell it to meet the mark. So it has the potential to go right back to where it was around the $1,900 or $1,800 level very quickly if further escalations in the Middle East don't happen. So we talked about this. I was actually really looking forward to buying more gold. And I was planning to do it in the fourth quarter. But I'm not going to chase it at these levels because I think I will still get a chance to buy more of it back at a lower level. If I'm wrong, thank God I already own it and I already have it in my portfolio. And I think if you don't own any gold, you should absolutely go buy some, regardless of what the price is. But because of the real yields component, and because I think real yields are going higher, and I think there will be more clarity come out of the Middle East, and I think some of that war premium, or however you want to describe that, that's in gold right now will get removed. I think gold will fall in the weeks and months ahead.
Look, on the real yield side of things, are you looking at it from a standpoint of, because the trend in inflation is going lower, without naming the individual, a well-known hedge fund manager was very short U.S. bonds, flipped out of that short position, made that announcement, and basically said there's too much craziness going on in the world to not own the world's pristine collateral. So do you think, doesn't mean that we're going to see a major fall in yields because everyone rushes into bonds for safe haven reasons, but the likelihood that gold pulls back on some sort of stability, wink, wink, air quotes, in the Middle East, do you think that comes off of the fact that bond yields are going to be lower, at least keeping the current embedded real yield we have right now in place if inflation continues to cool?
Well, I think gold I think gold will mainly pull back, not necessarily on real yields going higher. I think real yields may just kind of stay at these levels. I don't necessarily think real yields are going a lot higher than they are now. But I guess my point is at this level of real yields, if the war premium or Armageddon premium that's in gold right now gets removed, I don't think gold stays at $2,000. Now, I'm going to say this again. I think gold's going to $5,000. I'm a huge gold bull long term. This is a short-term tactical call against a longer-term bullish gold position or prediction. But I think the other reason why yields might stay higher for longer, so even if inflation doesn't fall, right, I think real yields might stay higher longer because I think 10-year yields might stay higher, partly because of what's going on in the Middle East, because the U.S. is going to help fund what's going on over there. The U.S. is already running a massive budget deficit. They're going to run an even bigger budget deficit next year. And now if we have to pay for a war in Ukraine, a war in the Middle East, and then if something flares up in Taiwan, right, we got to send something over there, the budget deficit is going to get massive. And I hear all these crazy big predictions for the budget deficit. I think they're going to be bigger than that. And so I think the U.S. Treasury is going to sell so many bonds, it's going to push yields higher. And so I think that in a vacuum negatively affects gold. Now, if the Middle East continues to flare up and we get all kinds of geopolitical conflict and, people rush into gold because they want to get out of fiat and they want some kind of a safe store value, then gold can absolutely go higher. And if anybody wanted to make that argument, I'd say, yeah, you're right. That's absolutely possible. I've never seen gold spike on a geopolitical conflict where it didn't give it all back within a couple months. So that's where I'm going to stay at right now.
Well, and you had mentioned for various reasons why you think yields will remain high, the budget deficit being one of the last things that you said, reinforcing your point that you understand where if there's tensions that continue to escalate or flare up, then there's going to be this potential flight to safety in gold, but that doesn't necessarily stick around very long. But, one of the other assets that benefits from the flight to safety, even in a high yield, a low bond price environment, is the US dollar. And this is something that, you have to constantly reinforce when people pin you as the dollar guy, even though you're clearly a gold bug, is because the dollar milkshake theory is really just saying this is all about being aware of the relative game. And so amidst this relative game, how do you think the current situation, both in the Middle East, gold price, real yields, the dollar, etc., continues to weigh on emerging markets and ultimately reinforces your dollar milkshake theory.
So over the last couple of days, last week there have been charts going around because as 10-year yields have risen, they're almost as high as the emerging markets, or in some cases they are as high as emerging markets. And there's a point of view out there, a very popular point of view is that, see, this is the United States, it's becoming an emerging market. Nobody wants to buy their debt. They're going to go bankrupt. The dollar's going to fail. This is further proof of it. And listen, I am sympathetic to that point of view, but I think what people don't, and if I want to make sure I don't want to say this in a way that offends anybody. And when I say that, I mean that. I'm not trying to be a jerk here, but if you don't understand how the capital flows work, it's very easy to misinterpret what this chart is telling you. You could say that this is an indication that nobody wants to buy the U.S. Treasury's debt, and that it's on a path to insolvency, and they won't be able to afford these interest rates. Okay. I understand that point of view. The problem is that every treasury auction continues to be oversubscribed. We've had more flows into treasuries this year than in any year in the last 20 years. And then people will say, well, yeah, but that's just the primary dealers that have to buy it at auction. Well, you're right, but they do have to buy it at auction. So if they have to buy it at auction, how is the treasury not going to get funded, right? So it gets very circular. And the point is the game rigged in the favor of the U.S. Treasury? Yes. Hello. The game is rigged in the favor of the U.S. Treasury. So why bet against it? Okay, so that's number one. Number two, every central bank, every pension fund, every endowment fund, every, significant capital pool in the world owns U.S. Treasuries in it. Every one of them. So if U.S. Treasuries go bankrupt, then all of these institutions, the central banks, the pension funds, the hedge funds, the endowment funds, then they're all going to go bankrupt too. So you're not, and again, this is not just U.S. entities I'm talking about. This is global central banks. The global central banks around the world, they hold reserves in U.S. Treasuries. That's what their savings is in. So if treasuries implode and disappear, that's not good for those other countries because they've just lost their savings accounts. Now, is that bad for the U.S. as well? Yes, that would be really bad for the U.S. as well, but it would not be bad for the U.S. in isolation. Okay, so now we also got to think that all of those other countries, if their central banks are going bust because their assets are disappearing, what's happening to the currencies of those other countries? Those other currencies aren't going to be in good shape if their central banks and their governments are going bankrupt. So again, you gotta understand how the system is organized and what sits at the base layer. And what sits at the base layer is U.S. Treasury bonds and U.S. dollars. And so if on a global level, if you are a global entity who operates on the global stage, you need dollars to operate. And we've been over this a million times, but that's the way it currently is. I don't care if you like it. I don't care if you think it shouldn't be that way. That's the way it is. So if all of these global entities need dollars to operate on the global stage, and they can choose between buying a U.S. Treasury bond that yields 5, 6, 7%, or buying a Chilean sovereign bond, which one are they going to buy, right? If you can buy a U.S. Treasury bond, which you have to operate, or U.S. dollars to operate, and you get paid 5, 6, or 7%, or you could buy an Egyptian Treasury. Are you going to buy the Egyptian Treasury? Like, which one are you going to? Again, this is a relative game, right? Let's say you've got a basketball game and you're on the playground and you're picking teams, and you're the best player, but the other 9 are horrible players. One of them is the best horrible player, right? But now let's pretend that you're picking teams and the other 9 are a bunch of guys who have a history of tripping over their own feet, missing shots, making turnovers. And then the other guy is, LeBron James. Are you not going to pick LeBron James? Now, again, you may think LeBron's getting old. He's not what he used to be. Can't quite jump as high as he used to. He's missing more shots. He's very arrogant, doesn't play nice with others. But are you still going to pick him? Of course you're still going to pick him, right? And so that's kind of how it is. If so this chart that shows U.S. Treasuries yielding the same amount as emerging markets, that is horrible for emerging markets. And the reason it's horrible for emerging markets is these emerging market countries, they fund their country operations the same way the United States funds their operations, right? They sell treasury bonds, they get the money, and then they go spend it and operate their countries. One of the ways that they attract capital is they pay more, typically, than a U.S. Treasury. If the U.S. Treasury now pays the same amount as these emerging market countries, money is going to go to treasuries. And when money goes to treasuries, guess where it isn't going? It isn't going to emerging markets. This is the perfect analogy here is what's going on with the banks in the United States. The reason that the banks had a big problem in the spring of this year was because money was leaving the banks and going into U.S. Treasury bonds because the yields were higher. And as the money left those banks were left without liquidity, and then they got into trouble and they started to go bankrupt. It's the exact same thing with the emerging markets. If the emerging markets are not paying more than U.S. Treasuries, global asset allocators are not going to allocate to emerging market countries when they can allocate to a U.S. Treasury, which is AAA rated. They will never in a million years get fired for buying a U.S. Treasury. It pays them the same amount. It has better liquidity. It gives them a higher rating on when their auditors come in and when their financial accountants come in. That is going to deprive the rest of the world and these emerging markets of much needed liquidity. And that is literally the dollar milkshake theory. So I think, again, you don't have to like it, and perhaps there is another way to view it, but let's just watch and see how this plays out. And if you think higher yields in the U.S. is only bad for the United States, and this is good for emerging markets, let's just watch and see how the next year plays out, and we can revisit this.
And ladies and gentlemen, that is literally the dollar milkshake theory. So
sorry, did I sound a little preachy there?
No, not at all. You sound like 10 p.m. Brent. Ladies and gentlemen, thank you for the jazz hour with the Milkshake Man.
10 p.m. Brent is much better than 8 a.m. Brent. I mean, let's be honest.
I agree. I've had a lot of 10 p.m. Brent and only the occasional 8 a.m. Brent. But, we've been on this movie analogy kind of theme. Part of that has included Michael J. Fox. When you were making the basketball analogy, it made me think of Teen Wolf. Mainly because how it would be in this spontaneous moments, particularly when you really aggravated him, that he'd become the werewolf. And so you made the analogy of LeBron James, but understand too that it's usually in these extreme environments where the U.S. and the dollar particularly is pushed far into the corner that you really see the dynamics of how the system works explode and create a lot of chaos. Now, to unpack some of the other things that you shared, I think are very important for people to think on, especially if you're not super familiar with the deepest inner workings of what you explained in the dollar milkshake theory, is I think this bank example is very, very important. So I think it's easier to visualize the fact that you have a weak bank or small regional bank. It doesn't feel as safe. The balance sheet isn't as strong. Suddenly, there's a much stronger, more attractive, paying more money place to park your money. And now you're seeing all of this capital flee out of the banks, the smaller, weaker ones. It's causing this banking crisis. The only reason we haven't actually had a severe banking crisis is because we are fortunate to have the Federal Reserve, whether you like them or not, they're still the central bank for the world's largest economy and the central bank that controls various forms of the price of money for the global reserve currency. So they're able to go in and create this BTFP, Bank Term Funding Program, and bail out the small, struggling, less solvent banks in the US banking system. There is no Federal Reserve for the Egyptian market. There is no Federal Reserve for the Chilean bond market. And so this is something you've expressed over and over. When it really does get bad, you're going to go to the place where you know you're going to at least get a life raft. It might not be, a 5-star luxury watercraft, but you know you're going to eventually get to shore. And so that's kind of the point here you're making in terms of, hey, when emerging markets are paying less or only the same as the world's cleanest dirty shirt, you know where the capital flight ultimately is going to go. And this goes back to something we've talked about a lot. And again, in this episode, where people are trying to fit their narrative around the data instead of taking the data for what it is. It sounds so much like the housing market. Everyone constantly wants to see this housing crash because it's a hated bull market. It's an artificial price because of the Fed did this and supply is that. And all of these things have elements of truth to them, but reality is the reality. And this is where the market sits right now. And I bring that up as one of my last points in response to the things you were sharing is that, and I'll add this video to the Start Here playlist, but a lot of what you mentioned and I just recapped is articulated, I think, incredibly well in the Start Here playlist in those 4 videos. But I'll add one more that's called When the Dollar Dies. It has a picture of the most recent Joker movie when he's on the car and he paints the smile on his face. Now, you had shared some thoughts on what happens when we do have this, end game scenario, and you were actually traveling in Argentina at the time when we did that interview, but you had mentioned the fact that, I think there's too much enthusiasm around this end game scenario. And I feel the same way about housing. It's like if there is a big severe housing crash, all the people cheering for it are not going to be the ones jumping in to catch the falling knife. When there is this severe monetary system reset, are you going to actually be one of the ones benefiting from it? You think you will, but are you for sure? And even if you do, what about your cousins, your aunties, your friends, your coworkers? And so there does seem to be kind of people getting lost in their own narrative.
Yeah. And, I've said several times that when I finally kind of, at least in my mind, kind of figured this whole thing out and how I came up with the dollar milkshake theory, part of the reason that I really felt I was on the right track is because I hated the answer. Hated it on a visceral level, and that's when I was like, well, hold on. Why do I hate this so much? And I was like, because I don't want it to happen. Well, why don't I want it to happen? Well, I don't think it's fair. Okay, well, is the world a fair place? No. And is it just because it's fair, does that mean that it's not going to happen? Well, no. Do bad things happen in the world? Well, yeah. So then why can't this happen? Well, it can. Well, why won't it happen? Well, it probably will. Okay, so if it probably will, then shouldn't that be what we're betting on, right? If we're putting our hard-earned capital at risk, shouldn't we put it in the place that we think is most likely to increase in value? And so I think that's what's really important to do here. And it's really, really hard, especially in an environment like we're in now, where emotions are so raw and everybody feels everything so strongly, right? I think the most important thing to do when you're allocating your capital or managing your nest egg is to be as brutally ruthless with the truth as you can be, whether you like the answer or not, try to figure out what's actually going to happen. And I think if you do that, you're going to be ahead of 99% of everybody else.
Well, whether you like the answer or not, we hope you enjoyed and liked this conversation. This will do it for our full-length episode. If you want to follow us on YouTube or really wherever else you enjoy listening to this type of conversation, you can do so looking for the Milkshakes Markets Madness Show in your favorite podcast or video player. We are on Spotify. We're on YouTube. If you're looking for us on YouTube, where we have these different playlists set up, you can use the handle Milkshakes Pod. If If you want to join Brent on Twitter, have conversations with him there, you can do so at Santiago AU Fund. You can find me on Twitter using John Kutsmeda. That'll wrap it up for us. We hopefully have you join us here in about a day for our Monday Peek of the Week, where we look at some of the upcoming economic calendar data, share some thoughts on where we think that may impact markets for the upcoming week. And that should do it. Brent, any last words?
No, I think this is going to be a crazy week. I mean, I think we've said that every week for the last 3 or 4 weeks, but I feel like they're just kind of compounding on top of each other, and it's definitely a time to kind of be on your toes.
I think whenever I occasionally at the wrap up of a show say, "Hey, Brent, any last words?" you always go, "No, but this is going to be a crazy week."
You know what? I think you're right. I think I do that.
So there you go, guys. It's going to be a crazy week. Enjoy your Back to the Future weekend or your Teen Wolf keg of beer and whatever else kind of fun that you decide to have. We had fun recording this. We hope you had fun watching it, and we'll see you guys all real soon.
Give me a keg of beer.
This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.